Thank you, guys. Good afternoon, everyone. Thanks for joining in. I'm Bryan Ducharme, the managing partner of Venture 7 Advisors. And just so you know, Venture 7 Advisors specializes in helping business owners manage strategic change. We spend all of our time helping clients buy companies, sell companies, reorganize, and adapt to changing markets. So the period of extreme tumult that we're in right now is sort of what we experience every day. And before we did this as a service, all of us were business owners ourselves. A couple of us owned a technology company that went through the dot-com boom and bust, which was also a crazy time. And I owned a construction company that, I guided through the housing recession of 2008, 2009. Along the way, between owning our own businesses and working with scores of other business owners, we've developed some tools that we find ourselves going to again and again that help us sort of bring order from chaos and focus everybody's minds on what's important. So today what we're going to do is look at 3 different planning tools that ideally will help you focus your thinking and make good decisions in the coming months and years. And I probably should also specify what we're not going to cover in this talk. We're not going to talk about COVID-19 and safety precautions. And we're not going to talk about any of the details associated with the flood of federal and state programs that have hit the market in terms of taxes and employment rules and loans and stuff. There's been a massive communication of those sorts of things, and we're not going to go over any of that stuff in this presentation. This is really about how to stay grounded when the bullets are flying and the economy is changing, sort of underneath your feet. Before we dive into the first sort of technique, I think it's important to acknowledge that this is different. Usually we get a chance to see a recession coming and we have a chance to fine-tune our business plans as it emerges. This is the first time that anyone can remember where we had a very strong economy that was deliberately shut down to save lives. And it's certainly been a shock to all of us in one respect or another. As we mentioned, there's also been unprecedented government economic support to sort of help the country get through this. But the reality is that the changes in employment law and tax policy and bank regulations, they're coming at us on an almost daily basis. That makes decision making even more complicated than it otherwise would be. Taken all together, we're in a situation where we've got unprecedented business uncertainty. And for most of us, uncertainty tends to translate into fear. And fear can certainly cloud decision making. For a lot of people, fear can be paralyzing, leading to indecision and sort of a state of denial. That was certainly the case. That's certainly what we observed over the last 2 or 3 weeks as we were checking in with our clients. There were a lot of people who really had no idea what to do next, or what to do first, what to do second, and how to respond to this. And one of the things that we did is we put together a tactical sort of action strategy for several of them. We later turned that into a sort of more general tactical strategy that was shared with hundreds of business owners in the region, and it was picked up by the Vermont Specialty Food Association. And that's really, that sort of checklist is what led to this presentation. The idea is to provide some thoughts on how to ground your thinking over the next several months in empirical data as best you can, to sort through the clutter and try and make the best decisions that you can. All of us make decisions based on emotions, at least as much as logic. And we all tend to exaggerate short-term fears and discount long-term fears. For example, a lot of the business owners that we've spoken with in the last few weeks, we could tell were really anxious about the idea of cutting their staff. Letting people go is always a very emotional and sort of difficult thing. But the weight of that fear was preventing them from taking steps that were clearly going to be necessary to save the organization. And we have clients, that were down 40% in revenue in 1 week a few weeks ago. Clearly the status quo was not going to be acceptable. So, there's a lot of research about how fear affects decision-making. We're not going to get into that now, but it's important to acknowledge that, you know, when the bullets are flying, we can't ignore the emotions that we're all dealing with as we're trying to get through this, but we can sort of try and break through that emotion once we've acknowledged it and make some decisions based on real data. And that's what we're going to look at. We're going to look at 3 different sort of decision-making tools to support short-term, medium-term, and longer-term decision-making. The kinds of things that can help you cut through the clutter and the panic, if you will, and make decisions based more on analysis and perhaps less on emotion. And like Alex said, after we review each of the tools, we'll have 5 minutes or so to answer questions about that specific tool. We're not going to let it go too long. If we have more questions, we'll pick them up at the end, but hopefully we can kind of break this into 3 logical sections that makes it easier for you guys to think about it, and we can provide whatever clarification is necessary as we go along. The first thing we're going to talk about is the most important, and that is survival. And this is where we spent a lot of our time in the last few weeks. In a crisis like we're in right now, where many of you have seen dramatic drops in revenue in a very short period of time, and some of you maybe even have been closed entirely, cash is more important than profit. A good business owner is always conditioned to think about profit, and it becomes a part of your conscious and unconscious mind. But at a time like this, where we don't really know how bad this is going to get and for how long, it's far more important to build up your reserves of cash so that you can survive to fight another day. So things like accelerating accounts receivable, if you have accounts receivable. We've encouraged clients to offer substantial, in some cases up to 15% discounts on outstanding invoices to bring that cash in now, so that the war chest can be fattened up a little bit. Certainly you should be thinking about slowing accounts payable to the extent that you can while continuing to operate. Inventory reduction is huge at a time like this. Those of you particularly that are sitting on finished goods inventory, our general recommendation is to blow that out as fast as you can. Return some if you can return it for cash. But this is a great time to have sales. Even if you don't make any money on the inventory, for many companies that aren't sitting on a large stockpile of cash, it's far more important to have the cash in hand than to have the potential profit from holding that inventory into the future. Obviously, anybody who hasn't filed income taxes should take advantage of the 90-day grace period. And some of you should be thinking about planning for asset sales. The last I checked, the auction values on a lot of basic kinds of equipment were holding up pretty good, but that's not going to last long. So if those of you who think that selling assets might be a good idea to get you through this thing, should be jumping on it quickly. I've even heard indirectly of business owners who say, hey, I know how to run this business. This is going to be crazy. They're selling everything, sitting on the cash and waiting to pick through the carnage that they assume is going to exist months or years down the road and start up all over again. That's obviously an extreme position, but it's really important to think about stockpiling cash right now and building up your sort of rainy day fund to get through this. The other thing that's important is to take advantage of any credit that's available to you. The first thing we told all of our clients to do is if they had outstanding, open balances on their letter of credit, draw it down right now and tuck that money aside, because at this point, banks are being very friendly and the federal government is providing some regulatory relief that allows banks to be more patient in the short term. But if there's one thing I know, it's that eventually banks will start behaving like banks. And when that happens, things like arbitrary reductions in lines of credit or lines of credit and notes being called, foreclosure procedures, those things are going to happen eventually. So to the extent that you have debt available to you now, grab it. Grab that cash, set it aside. Doesn't mean you'll necessarily spend it. You'll have to make that decision later based on the business planning that you go through over the coming months. But make sure you secure your access to whatever capital you can get your hands on now while it's still available to you. That includes emergency SBA loans and all those, other programs that are rolling out right now. And of course, everybody needs to be thinking about reducing expenses aggressively. This is an area where small business owners in particular tend to do too little, too late. Somewhere, I was trying to find it for this presentation, but someone surveyed CEOs of companies that were running companies in 2008, 2009 during the financial crisis. And I don't remember the exact details, but somewhere in the order of 3/4 of them, 2/3 to 3/4 of them said, if they had to do it again, they would cut deeper and cut faster. The tendency, especially among small business owners, where there tends to be a special bond between owner and employee, is to assume that this is going to blow over and do a small cut and then realize pretty quickly that you need to do another cut and then another cut. That can be devastating for morale. At a time like this, when everybody sort of recognizes that, we're in survival mode here, our general recommendation is to take a good hard look at the next 3 to 6 months and make the cuts that you need to make sooner rather than later. It'll be plenty easy to bring those people back and ramp back up for most companies a month or two from now if it turns out that things aren't as bad as we anticipate. But regardless of how aggressively you go, now is the time to reduce expenses aggressively, even if you happen to have a business that hasn't been hit by this just yet. There are a lot of businesses, for example, one of our clients makes candy and cookies, and they do a large Easter business. A lot of it's direct to consumer over the internet, but they do have a retail presence as well. And we're talking to them and they're like, hey, we're fine. The Easter orders are coming in and stuff. And our message to them was, hey, that's great. But even if people keep ordering candy while they're on quarantine, there's no escaping the fact that we're going to be looking at a significant economic recession for at least a quarter and probably more. So it's not too early to start thinking about what your business would look like if your revenue is down 25% 3 months from now. So that's our sort of general message in terms of prioritizing cash management over profit in the short term. The tool that we use for that, and that most people use for that, is the 13-week cash flow forecast. Now, I know that not some business owners are more comfortable with accounting and financial issues than others are. This is not an accounting exercise. There are no accrual entries. There are no balance sheet entries. This is just purely dollars in and dollars out. This is a way to put in, the last 4 weeks of your cash flow and project what that cash flow is going to be over the next 13 weeks. When are invoices due? If you're a direct seller, what do you think is going to happen with internet sales or direct sales? And again, this is the time to be conservative. Figure out all your sources of funds, whether that's underutilized line of credit, like we just talked about, customer deposits, additional investment that you manage to secure, new loans, whatever. The idea is to map all this out and take a cold, hard look at how long your business can survive in its current form in this current environment, and how long your business might survive if things get worse before they get better. Everyone's going to receive a copy of this spreadsheet. This particular spreadsheet was developed by a fellow by the name of Marty Mooney, and it was published on CFO University. I'm going to send this one out because this one's prettier than the ones that we generally use for our clients. It's got really easy ways to modify it and to sort of fill in the blanks and make this represent your business. It's really important to focus on cash. And when the bullets are flying, a tool like this can really help focus your mind on what's important. In fact, this type of a forecast is the primary tool of business turnaround specialists, the kind of consultants who go into insolvent businesses and try to rescue them. And the focus is entirely on cash flow in the short term so that the company can meet and or renegotiate its commitments. So this is something that everybody should be looking at right now, thinking about how long you can last in this environment if things get worse before they get better. Now, I mentioned that this isn't really an accounting exercise. Similarly, it doesn't really matter how accurate you are, at least initially. The point is to develop an objective picture of what the future might hold for your business, measure that daily or weekly against actual progress, and you'll be wrong more often than not. But the point is, why are you wrong? And what sort of underlying assumptions about your business should you change in order to forecast more accurately? So, many of you who have outstanding invoices might initially plug in all of your invoices into a tool like this based on the invoice due date. Well, payments are probably going to start slowing down if they haven't already. So maybe you assume that payments are going to come in 15 days later than usual. Great. Won't take too long to find out whether that's true or not. If it's not true, you'll understand that situation and you'll be in a position to change the assumptions on the rest of your open invoices and or get more aggressive with your customers about collection actions. So this sort of a tool allows you to do some what if analysis. If AR changes, what happens, how soon will you run out of cash? Should you borrow additional money if that's available to you, and if so, how much? If you're banking on an SBA loan, what happens if the loan takes 3 weeks longer to clear than they're promising right now? This is a format that's pretty easy for you to get your arms around to take a real tactical look at your business for the next several months. So that's the first tool that we're talking about. Let's take a break here, and Alex and or Brady, if there are any questions about this process or about the 13-week cash flow forecasting tool, we can spend a few minutes talking about that right now.
So we don't have anything in the chat right now. If people do want to, unmute and ask a question, feel free. Anybody have any questions related to this? Chat, or if you just want to, talk to us.
Okay. Obviously, if additional questions surface, we can cover them at the end as well. So, assuming whether you use the 13-week cash flow forecast or not, assuming you survive this short-term crazy period with business shutdowns and quarantines and stuff, the question becomes, what happens next? And while we are not prognosticators, you can certainly find as many predictions of the future as you want online these days or on the news. There are a couple of things that are pretty clear. One is we're going to see some economic headwinds for a while, maybe even, geopolitical instability, high unemployment, at least in the short term. It's going to take a while to get those people back to work, and people's pocketbooks are going to be hit. And longer term, our federal budget deficit is exploding, and at some point that's going to have to mean higher taxes and slower economic growth. So, we know we're heading into a tough time. And for the younger entrepreneurs out there who maybe haven't owned a business way back in 2008, 2009, this is going to be a culture shock. This is going to be something very different than the economy that we've seen over the last 11 years. The other thing that's pretty clear, at least to us, is that there are going to be some lasting changes in business and consumer behavior, the most obvious of which are changes in consumer behavior and changes of business practices. A lot of companies that never considered having their workers work remotely have invested a lot of money and are learning how to do that out of necessity. What does that mean for long-term trends about remote work? I don't know, but it's probably going to take a pretty good jump up even after this is over. Same thing with distance learning, telemedicine, and obviously e-commerce is seeing a huge surge over the last couple of weeks, and probably will continue to see a surge at the expense of brick and mortar stores while we're all, sitting in our homes or our home offices doing webinars like this. So it's going to be a crazy time, and the companies that survive this crazy time are going to be the ones that can sort of go back to their roots, think entrepreneurially, be creative, and be decisive. And the companies that do that successfully are going to be best positioned to capitalize on the opportunities, because sure, there's plenty of doom and gloom out there, but change always creates new opportunities for people who are looking for it and who are well positioned to capitalize on it. One of the things I think we're going to see in Vermont is, much like after 9/11, there are going to be a lot of people in cities like New York that are going to see, pandemics as a new kind of fear, like terrorism was. And some of them are just going to say, to heck with it. I'm going to go move into my second home and I'm just going to stay there and work remotely. Or I'm going to buy a small business and live in the Adirondacks or the Berkshires or someplace that isn't as scary as, big cities are right now. And that could certainly be an opportunity for different businesses in Vermont. For sure, everyone's going to have more hiring flexibility. Most of you have probably been struggling to hire good people for the last several years. Well, that's going to get a lot easier. We're going to have low interest rates, more stimulus spending, and the other opportunity that people need to think about is there are going to be opportunities to buy distressed equipment from people who don't handle this crisis very well, and they're going to be business acquisition opportunities for people that have the resources to do that. Several of our clients are actually starting to think about making acquisitions now, and when is the best time, might be the best time for them to take advantage of the fact that some of their competitors are weaker than they are, and they might be an opportunity to acquire them under attractive terms. So we don't know exactly what's going to happen, but we certainly know that the world is going to change. What you all need to figure out is, how do you need to change your business model to deal with it, to adapt to that change? And that's really where some of these planning techniques come into play, because once the initial crisis is over and we're no longer afraid of catching a fatal disease from our neighbors and things sort of get back to work, there's still going to be plenty of fear out there and plenty of anxiety and stressful situations to deal with. So how do you make good decisions in an environment like that and give yourself the best chance of adapting your business model to the new reality? And that's really what we're going to talk about. One of the simplest and perhaps most neglected tools of business planning is sensitivity analysis, or what-if analysis. I'm just going to go through a quick example, and then we can talk a little bit about how it might apply to different business models. But suppose in response to the changing situation of our economy, you develop a new product idea, and your business model is predicated on the fact that you can sell it for $12 a unit. You have variable costs of $5 a unit. Fixed costs are going to be $200,000 a year, and you think you can sell 50,000 units. Doesn't take a whole lot of math to figure out that if you realize that plan, you're looking at revenue of $600,000 and a profit of $150,000. That's great. I hope all of you can come up with really nice, profitable, enhancements to your business model just like this. But the challenge is, what if you're wrong? Or what if you're right? And what if the economic conditions change further? And that's really where sensitivity analysis comes in. So what happens? How can we test our assumptions and figure out where we really need to spend our time and which aspects of the plan we really need to make work? So let's assume that either your assumption is wrong or the market has changed in such a way to make your assumptions wrong. And instead of getting $12 a unit, you only average $10.80 a unit. Maybe that means you sell more to the wholesale channel than you predicted. So it could be good news, but it still impacts your business plan. Suppose your variable costs are 10% more than you expect, or same with your fixed costs. Or suppose your volume projection is off by 5,000 units. What we're really trying to do here is say, okay, if one of those things happens, what does it mean? And if we go through and look at each of those assumptions one at a time, we can realize that some of these assumptions are far more critical to the success of the business plan than others. For example, if you're right about everything, but the selling price turns out to be $10.80 instead of $12 a unit, your profit drops from $150,000 to $90,000. That's a 40% decline in profit from a 10% variance in purchase price. Clearly, that's an area that's going to warrant some of your attention in the planning stage and also in the management stage. If you get the price right and everything else right, but your variable costs are off by 10%, that only impacts profit 17%. Similarly, a fixed cost variance is not that damaging to the overall profit model. If your volume is off, you're down 23%. So you go through an exercise like this, and one of the things that you might be thinking about is, okay, clearly getting $12 a unit is very important to my business model. So maybe that means you invest a little more in the direct sales channel where you're more likely to get that $12 unit, or that unit price. Or maybe you look at this and say, geez, if I just increase my variable cost by 10%, maybe I increase the quantity of my product by 10%, or maybe I increase the quality somehow by 10%. That only impacts my profit 17%, but if it helps me protect that $12 sale price, then that's a good decision, right? So you get the idea. The idea is, you know, as entrepreneurs, we can be inherently optimistic at times. And it's really easy to say, oh, this is what I'm going to do. I'm going to do this, 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 and this, and this is how much money I'm going to make. This is a technique for sort of testing your assumptions, and if nothing else, focusing your attention on those elements of your assumptions that are going to be most important to a successful outcome. And much like the cash flow analysis, you know, the cash flow forecasting, it's not so much about how accurate you are or how accurate you aren't. It's about understanding the key levers of your model and making sure that you focus your time where it's going to have the biggest impact on your business. So this is a really simple technique that you can test, you can use to, you know, to test your assumptions and focus your effort. Obviously, there's some limitations to it, right? We were using very high level data, like, you know, for average fixed costs and average variable costs per unit. You know, what if you've got 10 products using the same fixed asset base and all those products are different prices? It doesn't take too long before the approach we just used becomes overly complex to do, at least in the way that we did it. And we're going to talk a little bit about that in a minute. But before we do that, this is another one of those pauses where we can stop and take questions if anybody has them.
Oh my God.
I'm looping.
So I tried to unmute everybody so anybody could ask any questions, but it got super loud really quickly. If you do have questions, I don't see anything in the chat, but you know, feel free to unmute yourselves right now. Again, we can take questions over the chat. We can take questions, you know, just if you have them to ask, but now's your chance, and we'll have some more questions at the end. So if you don't feel like asking right now, we can handle it then as well.
So Brady, did I hear you say there are no questions so we can move ahead?
Yep, I am not getting any questions, so we will move ahead, and there'll be more time after this as well.
Okay. So up until now, you know, the basic point is that whether you're focusing on short-term survival or whether you want to do some high-level tests on some modifications to your business plan or your business model, the basic idea is that, you know, when the bullets are flying and you're either unduly optimistic or unduly pessimistic about your future, the idea is to develop the discipline to document your assumptions, you know, write them down someplace or plug them into a spreadsheet and take a good hard look at them and run some what-if analysis. Now, obviously, what-if analysis gets pretty complicated pretty quickly unless you have a more sophisticated way of pulling in key information about your business. And, you know, one of the ways that we do that for our clients and with our clients is through basic spreadsheet financial modeling. Now, I can tell you that very few business owners get excited about this topic. And that many make a decision not to invest the time to do it, either because they're uncomfortable about financials or because they're too busy conquering the next market, hiring the next employee, or doing whatever it is that gets them excited. Very few business owners get excited about this part of the process. I can tell you, however, that those of our clients who went into this crisis with a reasonable model that they maintained are infinitely better positioned and infinitely more likely to survive this crisis than those that decided not to. In fact, many of them are scrambling now to patch together models to help them, align their business models with what they believe is going to be the new reality. So I get that this is not an exciting process, and I get that this might even be a daunting process at this particular point in time. That's why everyone's going to receive a sample business model that you can look at when you're ready to look at it. But it's also why I'm going to tell you a few stories about just what a profound impact that this sort of process can have on your business. The basic idea is to take data that you probably already have somewhere anyway, like revenue projections or bill of materials for your product or margin estimates for different categories of product and stuff. All of the things that need to go into a business model like this. What you might not know or might not have tried to do yet is tie them all together in a spreadsheet and put numbers to some of them that might be more abstract ideas and tie them into projected financial statements. That's the part where you might need a little help unless you've got a pretty good, pretty strong accounting background. Those of you who have gone through and raised capital or done a startup, in the last several years have probably done something like this in order to put together projections to show investors. But what I'm talking about is a little more sophisticated than what most people go through. The idea is to, in stages, basically create a virtual representation of your business, which will allow you to change some of the key underlying assumptions of your business plan and see what happens if things don't work out the way you expect. So I'm going to talk a little bit about the sample business model that everyone on this presentation is going to receive, so you'll know what it is that you're looking at. And then once we go through a basic discussion of that, I'm going to tell you a different story about one of our clients that used this modeling process to completely change their business strategy in the last 3 weeks as a response to the COVID-19 crisis. So you can get a sense for just how profound the impact can be. So the spreadsheet that everyone is going to receive is very simple. It's a version of a model that we developed for a client who is in the process of acquiring the company that he works for from his boss. So it's a management buyout of a consulting company. He has some specific plans about how he would change the business if he owned it. We modeled some of those assumptions to give him some idea on whether it made sense. We also fed that into projected financials for the bank financing, and we actually used the model to start negotiating the deal and understand the implications of different deal values and different deal structures. So that was why we did the model, but beyond that, the model, after the transaction is completed, the model will act as an operating budget, if you will, for our client that he can use to track his progress month to month and see if the changes that he's made are having the intended effect. And again, that's really the key point. So what you'll see in the spreadsheet that you receive will be a profit and loss statement going out 36 months, a balance sheet going out 36 months, and a statement of cash flows going out 36 months. That'll be mildly interesting because all of them are tied together and integrated in a way that, sort of shows one way on how to pull those things together. What I'd really like you to focus on, though, is the one spreadsheet, the one worksheet before those called Rev Worksheet, because this is really where the modeling happens. And before I forget to mention this, I'm going to just go through this really quickly. Many of you may not decide to dive into that particular spreadsheet for a while, and that's okay. If any of you decide that you want to dig in and you have any questions, everyone is more than welcome to call me anytime about the top general topics of this presentation, but specifically about how you might adapt the particular spreadsheet that I'm going to share with you to your unique business model. So just know that, You can dig into this later and we'll still help you understand what it is and how it might be relevant to your business. But in a nutshell, when you focus on the revenue worksheet, what you'll see is that you'll see each consultant in the firm defined without names. You'll see how much they're paid, whether salary or hourly. You'll see things like their average historical billing rate per hour, and you'll see their utilization rate. And utilization is a really important measurement for consulting companies. It's basically what percentage of your staff are billable versus non-billable. So our client had some ideas about how to change the employee compensation model to reward people for working more overtime and billing more overtime. The current owner doesn't like overtime, doesn't pay for overtime, and our client believes that they're leaving a lot of money on the table because a lot of their clients would like to get 50 or 60 hours a week out of some of their consultants at times, and they're not getting that now. So if you look at it, you'll see that the assumed utilization of each employee goes up over time as these changes to the business model are implemented and as employees adapt to the new compensation strategy. Now, in your business, there may be different critical assumptions like raw materials costs or production throughput or foot traffic or whatever. That's really not the point. The point for this example is if you look at the business model and you see what changes over time, you can very quickly see what impact that has on the profit and loss and the balance sheet. And you can go in there and change those assumptions, and it ripples through all of the sheets and shows you what happens. And that's really what this is about, is finding a way to document what you're thinking, test each of your key assumptions, and then pull all of your assumptions together into a way that translates into some level of a financial statement so that you can do a more sophisticated analysis of what happens if I change these 2 things or these 3 things or these 5 things. And as reality happens, and your actual results come in, you have a way to compare them against your assumptions and not get caught by surprise. For example, one of our clients, they weren't a client at the time, but one of our clients was growing like gangbusters last year, hired a couple of new technicians, bought a couple of new service trucks, and did that in the fall. And then all of a sudden got the financials in mid-January for the 4th quarter and found out she lost money. And what had happened was, rather than thinking through the impact of those hires and the ramp up of those employees and the cost of that new equipment and balancing that against December, which is always a slow month anyway in her particular industry, it was just great guns. And she didn't realize that it was a problem until long after the quarter was over because she wasn't looking at financials on a month-to-month basis. Now, it's something that she's recovered from in the 1st quarter of the year, before things got crazy with COVID-19. But the point is, it's really important to have the discipline of projecting what you think is going to happen and making the best decision that you possibly can, and checking your actuals on a regular basis so that if you did make a mistaken assumption, and we're all going to make bad assumptions in the coming months, you recognize it and you have the best opportunity to pivot and recover before you run out of cash or something drastic happens. So that's the basic idea and the reason why it's important to take the time to pull together and sort of do a mass sensitivity analysis on all of the key variables of your business, because they're going to change and you need to understand that change as quickly as possible. Now, I just want to tell you one quick story about just how profound the investment in this sort of a process can be. One of our clients is a very successful manufacturer of specialty tools. They sell their tools for about $5,000 a piece. They're slightly customized. The tools are made up of 60 to 70 precisely machined parts, right? When they started this company about 5 years ago, every part had to be purchased, and they'd come in and they'd hand fit them and put them together and customize them for their customers. And they realized pretty quickly that the vendors were terrible. All the vendors were over-promising, under-delivering. There was quality problems. What that led to after about a year and a half is a decision that they're going to have to make all of their own parts in-house. So they started buying multi-axis CNC machine tools and hiring machinists. Next thing you know, their factory needs to get bigger, and then they need to upgrade the wiring for the machines, and then there's more CNC machine tools come in. They've been straining because of real estate and factory space for 2.5 years. In fact, it got so bad they actually bought the building they were leasing from so they could kick some tenants out and take over the space. So there's all sorts of investment that's happened, and they're on this mission to add more and more CNC machine tools and more machinists and be able to take over more and more of their own production. Meanwhile, the company's growing like crazy. It's almost doubling every year. You know, they've gone from a few units a month to 60 to 70 units a month in the interim. So we started working with them late last year, early this year, to put together a financial model, because we were going to go out and help them raise $3 million to build a new 20,000 square foot factory and fill it with machine tools, because, you know, to fuel their growth and to reduce their dependence on these vendors that have been a problem. And then COVID-19 happens. Clearly, this is not a great time to be going out looking for new capital. It's also not a good time to be buying real estate, because the assumption is that real estate prices are going to soften, and maybe some existing buildings that are out of reach right now will become more feasible 12 or 18 months down the road. So we took a major time out. We pulled up the business model and we said, okay, let's look at each of the assumptions that we've defined and think about how we might do this differently. One of the things that occurred to us is that if we sourced parts instead of made them, this company would be spending $1 million a year on parts at a time when the machine shops that they've historically dealt with are losing business. So maybe, you know, relying on vendors isn't such a bad thing after all. So we made some vendor phone calls, and we even talked to some of the bigger vendors that wouldn't give this company the time of day a few years ago, and found out, lo and behold, they're interested. So we changed the business model to assume that the existing production capacity would focus on the highest value parts or the most time sensitive parts, and we'd source the rest. We made very conservative assumptions about safety stocks and lead times and unit prices from the vendors. And we knew that gross margins were going to take a hit because it costs more money to pay a vendor to make a part than it might to make it internally. When we got through that whole process, lo and behold, we realized that we could increase this company's revenue 2.5 times in its existing footprint if we changed the assumptions about what we made internally and what was sourced out externally. All of a sudden, the pressure to find more real estate is not nearly as great. When that does hit, presumably we'll be in a weaker real estate market than we are right now, with lower interest rates and perhaps some distressed businesses. And we modeled this out over the next 3 years and looked at what the value of the company is likely to be based on those financials. And because the owner is not going to have to sell equity to raise money, and because this business model is so much more efficient, the actual value, the owner's value of the company, is almost twice as high 3 years with this model than it would have been under the previous model. So in a matter of 3 weeks, the manufacturing strategy and the sourcing strategy had completely changed. That had some implications for product mix as well. But the whole strategy changed in 3 weeks. And what made it possible for our client to do that with confidence was the fact that we had a financial model in place that allowed us to play around with some of the key assumptions and see what the implication was, see what the implications on the finances were. That's really the sort of capability that you need to gravitate towards as you adapt your business model to the new world, however the new world ends up taking shape. I know it's a pain, and I know that people don't like to do it, but every single client or associate that I've ever worked with to do this has come through it at the end and said, man, this really changed the way I think about my business. Sort of the argument here is that everybody needs to think about the way they run their business in times like this. And this is a really powerful tool that can sort of force you to develop the discipline to document your key assumptions, test them, and run some scenarios, and most importantly, measure your actuals against those scenarios so that you're in a position to respond. So those are the three tools that we covered today: cash flow forecasting, so you can survive the crisis; basic sensitivity analysis that allows you to test sort of fundamental business assumptions at a high level; and then if you have a more complex plan that generally calls for more complex financial modeling over time, to give you the tools to have the confidence that you're going to need to make bets in what promises to be a very dynamic environment over the next couple of years. So, good luck, everyone. Be creative, be decisive, and hopefully some of these tools will help you clarify your thinking in the